Welcome back to the Deep Dive. Today, we are cutting straight into the Q3 2025 results from Pan American Silver, or PAS. The company dropped its numbers and held their call midday on November 13th, and the market reaction was immediately positive, almost surprisingly so.
It really was. It was a classic tale of two stories in one report. On one hand, you had these minor headline misses against what the analysts were expecting, both on earnings and on revenue.
Right. But on the other hand, the stock actually closed higher that day.
Exactly. So our mission here is to really dig in and uncover why the big investors, the institutional money, basically ignored those small misses and bought into the bigger structural story instead.
And that structural story, it's all about this massive inflection point in free cash flow, isn't it? It's being driven by the new output from that Meg Silver acquisition.
It is. We really need to unpack how one single move is fundamentally changing the entire financial platform for PAAs. It's turning them from, just another cyclical silver play into something much, much more solid.
Okay, so let's start with the numbers that made people a little nervous at first. Against expectations, the results did look a bit soft.
They did. Adjusted EPS came in at 48 cents. The Zacks consensus was 49, so a small 2% miss.
And revenue was similar, $854.6 million, when the street was looking for about $867.8 million, a 1.5% miss there.
That's the GAAP consensus side of the coin, the short-term view. But if you look just a little deeper, the story completely flips.
How so?
While their GAAP EPS soared to 45 cents, that's up from just 16 cents in the same quarter last year. It's almost a 200% increase. So management didn't really waste time defending the misses. They just pivoted to the growth story, highlighting these record attributable results, which actually hit $884 million.
And the market bought it. Why do you think their narrative won out over the consensus numbers? I mean, usually a miss gets punished.
Because the market is always looking forward. The consensus models, they just couldn't fully bake in the immediate impact of the Juanicipio mine that quickly. So when investors looked past that little bit of noise, they saw real, tangible proof of a structural improvement. A better cost structure, way more cash, and that's a much bigger story than a 1 cent miss on EPS.
So that positive pop in the stock was really a signal that cash is king again, and PAS is delivering.
Yes, and that takes us right to the heart of the bull case. This incredible cash flow inflection.
Let's get into those numbers.
Absolutely. I mean, the figures here are genuinely transformational, attributable cash flow from operations, a record $323.6 million.
Okay, but the real health metric is free cash flow, especially for a miner.
And that's the showstopper. Attributable free cash flow hit an unprecedented $251.7 million.
$250 million in one quarter. How does that stack up historically, and what was the engine behind that kind of jump?
That number is a nearly 67% increase year over year. The impact is just staggering. It basically builds a financial floor under the company that wasn't there before. And the source, as you said, is the immediate impact from the high-grade Juanicipio mine.
And the crazy thing is, the Mag Silver deal only closed on September 4th. That's just 1 month of contribution in the third quarter.
1 month. And their 44% interest added 580,000 ounces of silver just like that. It shows you the incredible quality of that asset.
And the financial leverage must have been immediate. What did it do to their cost profile in the silver segment?
The drop was dramatic. All-in sustaining costs, or AISC, fell to $15.43 an ounce. Cash costs were down at $10.41. That AISC is about a 21% reduction from the same quarter in 2024. This isn't just commodity prices helping. This is a real efficiency gain.
Seeing costs fall that sharply, that fast, it must give management a ton of confidence, and they reflected that in the guidance.
They absolutely did. They raised their full-year silver production guidance to a tighter, higher range, 22 to 22.5 million ounces. And, crucially, they also cut their AISC guidance for the silver segment. The new range is $14.50 to $16 an ounce. Doing both at the same time tells you they believe this new, lower cost profile is here to stay.
So what does a company do with a massive new FCF cushion? How does that translate to capital returns for you, the investor?
An immediate dividend hike.
I saw that.
The quarterly dividend was raised to 14 cents a share, up from 12. And management really emphasized this was a discretionary increase, directly enabled by the new FCF levels. It was a signal that they could boost returns even right after spending a lot on the MAG acquisition. And their overall liquidity is still great, about $1.7 billion. They're paying down debt and rewarding shareholders at the same time.
Okay, so the silver story is phenomenal. Juanicipio is a home run, and it's justifying the stock's performance. But we have to talk about the elephant in the room. The softness in the gold segment. That's what caused those headline misses.
It's a crucial question. Did the silver success just paper over some cracks in the gold operations?
Well, did it?
The numbers weren't great. Gold production did dip to about 183,000 ounces, and the gold segment AISC was high, $1,697 an ounce. Management pointed to some technical issues that dragged on through Q3 at a few mines, specifically Cerro Moro, El Peñón, Timmins, and Minera Florida.
That nearly $1,700 AISC is a real drag. What exactly were these technical issues, and how confident can we be that they'll actually fix them for Q4 like they promised?
Well, they were pretty transparent. They stuck to their original full-year gold guidance, which means they're banking on a very strong Q4. It's what they call a back-end weighted production profile. The issues weren't about the quality of the ore, but more operational hurdles. For example, at Timmins and Bell Creek, they got into specifics about using casings and polymers to deal with squeezing drill holes.
Wait, casings and polymers to stop drill holes from squeezing shut? That sounds like pretty serious geology they're dealing with. Is that a structural fix or more of a Band-Aid?
I'd say it implies a structural fix. They're actively investing in materials to stabilize the ground. It's common in deep mines, but the fact they detailed it suggests they're tackling the root cause to make sure Q4 output is reliable. It's not just hope.
Okay, that's reassuring. Now, another interesting detail was the lower silver grade at the Veran mine. Was that another unexpected problem?
No, and this is where you can see the operational discipline. The lower grades at Veran were actually planned. It was a strategic move. They're speeding up development right now to build an inventory of prepared, high-grade areas to mine later. So you take a temporary hit on your grade today.
For a big payoff in reliability down the road.
Exactly. The trade-off is for much better, more consistent production starting in mid-2027. It's about long-term planning.
And that strategic patience seems to apply to the whole portfolio. They're cleaning house, right? They mentioned selling the La Pipa project.
Yep. A $6.8 million gain on the sale of that non-core asset for $40 million in cash. It shows they're focused. They are pruning the portfolio to concentrate all that new FCF on just two things: keeping costs down and advancing their major growth projects.
Perfect segue. Let's pivot to those future catalysts, starting with the big one, La Colorada Skarn, or LCS. The resource there just keeps growing.
It does. They just added another 52.7 million ounces of inferred silver resource. It just reinforces the sheer scale. This thing has the potential to be a multi-decade mine.
But that scale also brings challenges, and it looks like they're evolving their strategy to a two-phase approach now. That feels like a smart way to de-risk a project that big.
Precisely. They're looking at a two-phase development, and very possibly with a partner. Phase one would be a smaller, higher-grade startup that ties into the current mine. It lets them start generating cash from the asset much sooner, without having to fund the entire massive project up front. Phase two comes later, the full-scale cave mine expansion.
So they can use the cash from Juanicipio to fund phase one, de-risking the whole thing. When do we get the full details on this new plan?
The new technical report, the PEA, that's scheduled for Q2 of 2026. But, and this is important, management said partnership talks are well advanced. They hinted they could announce a partner even before that PEA comes out. That's a huge potential catalyst for the stock that has nothing to do with the current operations.
That is a critical piece of the puzzle for long-term investors.
Okay, beyond LCS, they're also working on optimizing Jacobina. What's the plan there?
Jacobina is an older asset from the 80s, but has a lot of potential. The plan is ambitious. Two key projects: a new tailings facility to secure capacity out past the mid-2030s, and a paste backfill plant to improve recoveries in the high-grade zones. It's all about squeezing more life and more metal out of what they already have.
And finally, the ghost in the machine, Escobal, the massive high-impact asset in Guatemala that's been on hold. Any real news? The update was consistent. The ILO 169 consultation with the government and the Jinka Parliament is ongoing, it's active, it's respectful, but no firm timeline for restart. Still, the way they talk about it, you can tell it remains the single biggest potential re-rating event for this company. They are patiently, methodically working to unlock it.
So to sum up,
Yeah.
you have a company that's nailed a huge acquisition, fixed its silver costs, has a plan for its old assets, and has two monster growth projects in the pipeline. What does this mean for you, the investor, especially after the stock has already run up so much?
Well, PAA stock is up almost 80% over the last year. It's massively outpaced the S&P 500, really riding that strong precious metals wave, especially with silver flying above $50 an ounce recently.
And it seems like analysts are on board with the story now.
They are. The consensus is a moderate buy, and you see some really aggressive price targets out there, one as high as $62. The key takeaway is that PA is changing. It's moving from being just a play on the silver price to a structurally higher cash flow platform. But the very near-term focus has to be on Q4 results. They need to prove they've normalized those gold operations. If they do that, a lot of the remaining operational risk comes off the table.
And that structural flow or free cash flow is what makes it so interesting. It creates a solid base, but also opens up opportunities for more creative plays on that latent upside, like Escobal.
That is the perfect segue.
Okay, we are now entering the fun part of this deep dive. This is what we pitch: a high optionality, maybe low probability trade idea based on everything we've just talked about. And as always, please remember, this is for informational and entertainment purposes only. This is not financial advice.
The whole thesis for this trade is using the news strength of the company to basically buy a cheap lottery ticket on a geopolitical event. The successful integration of Juanicipio provides this strong, stable financial base. That's your floor. And that stability lets you go hunting for asymmetric optionality,
The ceiling.
which in this case is the eventual restart of Escobal.
But since the timing on that is a complete unknown, you need a structure that uses the current stability to pay for that long shot bet.
Exactly. So we're suggesting something like a collar strategy or a spread bet that's laser focused on Escobal's value. Here's how it could work. You could sell short-dated, deep out-of-the-money puts against PAS. By doing this, you're essentially collecting a premium based on the market's belief in that strong cash flow.
You're getting paid for the stability, and you take that cash, that premium.
And you use it to finance the purchase of long-dated calls. I'm talking way out, like 2027 deep out-of-the-money calls.
So you're paying very little for the right to buy the stock at a much higher price years from now.
Precisely. You're making a bet that the patient, successful resolution of that ILO 169 process, which management is clearly working towards, will trigger a massive, non-linear re-rating of the stock, a spike that would be almost totally independent of their day-to-day mining results.
It's a bet on geopolitical patience, funded by the company's new financial engine.
It's using the strength from Juanicipio to buy a very cheap ticket to the Escobal show.
That wraps up our analysis. The key takeaway from this deep dive is clear. PAA is officially in free cash flow maximization mode. It's being driven by Juanicipio. They're executing on their growth plan at La Colorada, and they are patiently guarding that huge latent asset in Escobal. The company is managing risk and looking to the future.
And given that the stock has already run up almost 80% this past year, here is a final provocative thought for you to think about. Is the market efficiently pricing in the timing risk of the La Colorada PEA in 2026 and the huge geopolitical question mark around Escobal? Or does that robust $251 million free cash flow cushion still offer a compelling entry point for silver exposure in what might be just the early innings of a major precious metals cycle?
Something important to mull over. Thank you for joining us for this deep dive.